Set of numbers, and I'm drawn to the top line that we've gone with. Your refining margins, you say, are expected to trend downwards. Give me the parameters. Percentage drop in refining margins are translated into dollars for me. What can we expect for the squeeze on margins?
Well, good morning, Manus. I appreciate your question. I think refining margins in the first quarter really benefited from maintenance activities as well as reduced arbitrage opportunities and increased spot demand in the Mediterranean. And I think we don't see that going into the next quarters. The refining margins was pretty high with a $5.4 per barrel in the first quarter. We expect to see now for the entire year at $4.7 per barrel refining margins, which is the level we have seen last year. So we have made adjusted. The situation in the refining market in Europe hasn't changed. We still have overcapacities in the market, and of course we are going to see some volume pressures of refined products being delivered from Russia and the Middle East.
Can I ask you, good morning to you, Rainer, can I ask you about the oil price and what your expectations are? I see you're talking about a $55 a barrel for Brent. That's a bit higher than where we are now. What do you see pushing that up? Do you see OPEC action being effective? Is that going to be the driver?
Well, we have seen in the first quarter $54 per barrel, so I'm convinced that I would like to stay with my 55 for the entire year 17. Of course, I think OPEC is going to make a decision here in Vienna on the 25th that they will continue with their production cut. If not, then we are going to see huge pressure on the oil price. And the main question is what kind of quotas they are going to agree. From my point of view, it will stabilize the oil price. We will see the oil price in the low 50s, so I stick to my 55.
You stick to your 55. What's your fear, though, if OPEC doesn't carry on with the cuts? What's your fear for how low it could go?
Oh, come on. That's a question. It will be below the 50. Nobody knows, really. But before the production cut, we have seen an oil price which went down to the 30s, if we remember what happened with the oversupply. But I think the signals are pretty clear from OPEC as well as from some non-OPEC members that they are ready to continue with their cuts. So my scenario is that they will continue with their production cuts.
OK, we'll ask you if it happens then, but I take your point, Rainer.
Let's talk about some of the business areas for you, Rainer. I want to talk to you about Iran. You recently reached a deal with Iran in terms of back payments for your former exploration. Can you give us any details on that? Can you confirm that? Can you firm that up for us?
Well, I can't give you any details right now because we are in the end phases of negotiations. So contracts are not signed right now, but we're in the end phases of negotiations.
And when do you have a time frame? Do you think that we're going to hear from you in terms of concluding those negotiations?
Oh, to be honest, I would like to close that deal yesterday.
Memories.
Talk to me about risk in the Iranian market at the moment, with sanctions lifted, but everything we've heard from the US administration. How risky do you see investing in Iran at the moment?
Well, I think, first of all, the queue of interested parties who would like to sign deals right now has been diminished. So we are still very much interested. The main challenge right now is still the financial transactions. So this is limiting us. This is more my concern. But in parallel, we are going to negotiate the terms of, and especially the economic terms we can get if we are going to invest into some oil fields.
You obviously, let's just switch countries for a moment. Let's talk about Libya. I mean, the great debate in the market is, can they get back above 1 million barrels a day? I'd love your opinion on that. And also in terms of your expansion there, you've just recently acquired Occidental's stake in the Nafora field. Is that too early to say that it's paying off, or what can it deliver?
Well, I would say it's paying off because the production is back. We have seen some interruptions, and I think my outlook for 2017 is that Libya will have a production. You have to deal with some interruptions because the one or the other wells is going to be shut down. It's more limitations of the availability of the infrastructure and not our production facilities. We have seen 16,000 barrels per day production in the first quarter. We think that we are going to produce something between 10 and 15 in the rest of the year. But Libya has done well. You know, they are now back to 800,000 barrels per day. And if I listen to Mustafa Sanala, who says that he would like to see the 1 million barrels per day at the end of the year, he's doing well on track right now.
So they've done well, you say, Rainer, but give us some insight into what it's like operating there at the moment. I mean, are you able to, have you been able to bring any foreign staff back into Libya? Do you have plans to? And are you fearful that activity on the ground, political activity, could impact on Libyan exports, could result in that being halted, for example?
Well, Anna, we cannot send any expats into Libya right now. The security situation doesn't allow us. But we can operate our facilities with the local staff, and we can go up to 50% of our capacities, which is pretty good in these times. But if we would like to increase to the max capacity, of course, we need to have the security situation to bring back our expats. The political situation in the country, I think there is still a conflict between the Libyan government and the militias, and especially with General Haftar. If they come to an agreement, I think we will see a further improvement in Libya, especially as we speak about the oil production.